Welcome to Between Two Chairs, Demystifying Commercial Real Estate, the podcast that brings you the latest insights and trends on the South Florida commercial real estate market, with your hosts, Fernando Arencibia Jr. and Jennifer Woolman. In each episode, we dive into the world of commercial real estate and break down complex concepts to make them accessible for everyone. Whether you're a real estate professional, a curious investor, or just interested in the South Florida market in general, Between Two Chairs is the podcast for you. So pull up a chair and join us.
Welcome, everybody, to another episode of Between Two Chairs. My name is Fernando Arencibia, and with me, as always, is the very formal Jennifer Woolman. Jennifer, say hi.
How do you say hi formally?
Oh, you say salutations.
Salutations. Oh, my gosh. That's how formal I am. Salutations.
You know, you learn something new every day.
Oh, my chair's going down all by itself. That's what happens when you try to act hoity-toity. The world brings you back down.
Well, you know, it's been a little cold here, and she's got a turtleneck and a nice black jacket, and she's looking very formal. And then all of a sudden, the chair just starts to descend on its own.
That's because I used salutations.
Yeah, exactly. Well, today we're going to speak about a topic that I know has created a lot of consternation for you, and we've had a lot of debate over it, and it is the concept of an accredited investor. And for those who don't know, an accredited investor is a person or an entity that the SEC presumes can bear the risk of private offerings for investment. It is something that was created through Regulation D. And basically, these are people that meet certain criteria based on income, net worth, and they have, specific financial credentials or rules. The idea here is basically that a private investment can be riskier and less transparent sometimes than the public markets, like the stock market, for example. And so the rule tries to balance, those investments trying to raise capital with protecting investors, and then that's how it is. So just to give you an idea, for individuals, the two most common paths are if you have an income of over $200,000 or $300,000 plus with your spouse and partner in each of the last 2 years with a reasonable expectation of the same this year, or you have a net worth of over $1 million, excluding your primary residence. It is believed, and I think that the last numbers came out in 2022, that about an estimated 24 million households would qualify overall. So we started to have this conversation about accredited investor because of your daughter's search for an investment property. So give us your perspective on how you see this not working the way that maybe it was intended to work.
So first of all, the way it was intended to work is kind of like the government saying, we know better than you do how to invest your money, and you're not sophisticated enough to invest, so we're gonna put up guardrails to protect you from yourself. Right. So I already have a problem with that because I do invest in the stock market, but I don't read the 52-page prospectus of stuff that comes out. Right. I invest in companies that I know, that I like, that I use, and there's risk to that. And I don't invest in crypto, but a lot of people do, and there's risk to that. So there's risk to any kind of investing, and I'm not real sure why these guardrails exist in today's market. Right. And I feel like not having them would help democratize investing in real estate, which is one of the fastest ways to create generational wealth. Yeah. Less and less people are buying their primary homes for a variety of reasons. One is affordability, two is mobility and flexibility, and three agree is because a lot of people think that tying up, and there are a lot of people in my family who think this way, that tying up so much money on a physical asset that's really an expense, right? Because it's a mortgage that's being paid, that money's better spent in an investment. And so they might not own their own home, but they would like to invest in real estate, right? They want to add real estate to their portfolio. And you can invest in real estate through the stock market, through REITs, right? But you're owning shares in the company, not the physical property. And this is similar, right? So you're basically owning shares. If you're an accredited investor, you're usually buying into a real estate syndication or fund, and again, you own shares of that, but you're part of the fund that owns the real estate, and it's usually it's a larger percentage, and it's a smaller fund than, let's say, a REIT that owns a ton of different properties. It could even be very property specific, and I think syndication's a great thing. I wish I'd known about it a lot sooner, because syndication is definitely passive investing if you're an LP, because you have an LP is a limited partner, because the general partner is the asset manager who's managing the physical property. What's great about syndication is that you don't have to buy a property 100% on your own and go out and get a mortgage and everything else, which again is ironic, because I could go out and get a mortgage for a fourplex or whatever, but if I want to get into a much bigger property for the same amount of money that I would have to down pay a mortgage for, I can't do that unless I meet this accredited investor criteria. So to me, that just, it makes no sense. And so this all started because...
And by the way, one of the criticisms of the program is that they... basically the wealth becomes a proxy for
creating wealth.
For sophistication. It's almost like, well, if you're earning this amount and you can prove and you have $1 million worth of net worth, excluding your single family home or your primary residence, then it's almost like it equates to sophistication. Like as if you have the ability to make wiser investment choices than someone who doesn't have that.
Right. And to me, it's also silly, because why would you exclude a primary residence? I have a ton of equity in my primary residence, but what if I never invested in the stock market because, I don't know, I decided to pay all cash for my kids' college or whatever. So all of my net worth is tied up in my home. I've been there 30-something years. I've got a lot of equity. Why wouldn't I be able to pull out some of that equity and invest in something else? To me, the whole premise is just kind of wonky, but and again, it becomes this risk issue. So in a lot of people's cases, not just my daughter, but there are a lot of people who graduated from college or who were in college that have knowledge of finances, that are great at saving money, they're hard workers, they probably do have money in the stock market, but maybe they have a friend, and I'm thinking of the guy, strip mall guy on LinkedIn, because he was having this issue with a friend of his son as well, at the same time that I was having it with my daughter, and it popped up. And that is that my daughter has been with me to the Beth Azor conferences. She's met the women. She's sat in on a bunch of the presentations that women have made, kind of talking about their investment strategy. She's gone over, the offering memorandum and the financials. She's sat in on calls, and she trusts this group of women. She knows I've been in real estate for 30 years. She knows that I do this. And so she is not going to buy a house because she's not sure where she's going next. She loves to travel. She's still, she's young with different career opportunities. And she felt like, buying her own property is going to tie her maybe to a place. But at the same time, she loves real estate. She loves Florida, and she wanted to invest. And so she found this project, she found this deal, and then it's like, accredited investor only. And so now she's like, okay, great. Now what do I do with all this money that I saved for a down payment for my house? And now I can invest it. So there's some other options questions that we are going to talk about later in another section. In another episode, we'll interview somebody who has some workarounds. But again, they're workarounds. You create a club, you have a platform, everyone has to vote. It's not the same thing as what we're doing with. It's not as straightforward. It's not as passive, and I think that actually has a lot less expertise involved, because it's basically any group of people can get together, create a club, and go out and buy a property and invest. And to me, that is way riskier than having a general partner or an asset manager who does this and just wants to raise funds among family and friends to be able to execute a purchase. So luckily, I'm not the only person who's having this issue. And it turns out that there is a lawsuit that has challenged the SEC's accredited investor definition, because they're saying that they're limiting and they're deciding for people in terms of how to invest the money, but those rules don't apply across the board to every investment. You don't need to be an accredited investor to buy art, to buy Bitcoin, to buy stocks, etc., as we discussed. So
what I found really interesting about the scenario that that your daughter finds herself in is that she has a mother that has, over 25 years of experience in real estate. She has connections. She's gone to these conferences herself, seen the people that are managing these properties, found an investment vehicle that really makes a lot of sense. She edits this podcast, so she gets immersed in everything that is happening in the commercial real estate sector and in real estate overall and in investments. And yet, she cannot put her money into this syndication, right? That is probably safer than, one of the examples that you mentioned is that she can go and just go ahead and buy crypto without having any knowledge. She can go take all her money to Vegas and just, risk it all on a roulette table, right? Yeah. But she can't take a calculated risk where she feels that it is connected. And one of the misconceptions about the whole accredited investor aspect is that if you're accredited, that means that that it's a safe investment. Well, in reality, a lot of these private deals are riskier and less liquid, right? And so you still have to do your due diligence. You still have to do that, which your daughter had done. Due diligence on who's gonna be the GP, who's going to manage the property, what experience do they have doing so? What are the other people that I'm investing with? Going to actually see the physical location and the physical property and being able to touch it and see the neighborhood and all those things. And again, we've created this sense that if you're an accredited investor, you're more sophisticated. But in reality, the way that the SEC has kind of looked at this is, or I guess one way to interpret it is that, if you have that level of money and net worth that you can afford to go into an investment that is, where you have illiquidity, that you're able to go and you have more capacity to diversify your investment somehow rather than stay in one lane. And I think that the potential to be more opportunistic in your investments, and I think that's the way they're approaching it. But there's a lot of people that are getting left behind. And if your daughter who searched for a home could not find really what she was looking for at a price that makes sense for her lifestyle and for her goals, but now she found, a vehicle where she could invest it in with the people that she trusts, including her own mother, who has 25 years of experience, then obviously we've hit into a unintended consequence of these rules that are really keeping a lot of people away from, being able to invest in probably what's going to be a safer vehicle than a lot of other options out there.
Right. So, and it's interesting because the Investor Choice Advocates Network wrote an interesting article on this whole accredited investor rule. And, they said with the accredited investor, this is a direct quote, with the accredited investor rule, the government is dividing the public into two classes, the wealthy who get access to opportunity and everyone everyone else who are told they don't measure up. And then they go on to say that the number of IPOs have reduced over the years, and the greatest growth often occurs in private markets. The result is predictable wealth. More wealth is accumulated by those who are already wealthy, while ordinary investors are seeing smaller returns on their investments. And when small businesses and entrepreneurs can't access capital from the people who believe in them the most, innovation stalls. And I think that's super interesting, and that's straight to the point, because we are trying to stimulate. To me, this is a much better economic stimulus than convincing people to go out and buy more on Amazon and retail shops and being a consumer-oriented society versus an investment-oriented one. And then they also contend that this rule is not constitutional because it goes against the right to the Administrative Procedure Act. It says it violates the Constitution and the Administrative Procedure Act because it has the government deciding the risk tolerance for people. Right. And so I thought that was interesting. So hopefully this will be resolved. I think it would be great if it did. I mean, there are a lot of people out there who would love to be able to invest, and I think it's a great way to create wealth. And that doesn't mean that people aren't going to lose money and make mistakes and not do their homework, but that happens every day. I'm thinking of a ton of stocks that I had invested in that didn't go,
It's funny because I was, when you were mentioning all those things, one of the things that came to my mind is these SPACs, which was basically a way for you to raise through an IPO. And you were basically putting your money that was going to go into a trust to then buy a company. You didn't even know what the ultimate acquisition of that SPAC was going to be. And I don't think historically SPACs have done very well. In fact, I think they've done, pretty bad, which is why you don't hear about them as often. But there was a period of time where that was all the rage and money was being raised through these SPACs. And, again, when I compare that to the opportunity that your daughter was faced with, man, that felt like a lot less risky and a lot more, a lot more of a level of certainty. And definitely there's something wrong that she couldn't really execute it.
Well, and I think, look at Enron, right? Enron was part of my 401k. It was something that all the money managers were saying, oh, you should allocate. Guess what? Enron no longer exists, wiped out all of that paper wealth. And so there's risk in every investment. It tells you every single prospectus that you read for any stock that you buy or any mutual fund that you buy into, it says, this is not a guarantee that you're going to make any money. You could lose everything.
And it's interesting because there is a way to do this that is more knowledge based as far as your experience and what and a lot of the stuff. Again, I've met plenty of people that make, every investment is a risk, and even if you're very knowledgeable, there are risks involved in that. But I think some of what people feel would be a great pathway would be for the SEC to expand some of that knowledge based eligibility, to add maybe something that is tied to training or testing on.
I disagree. I 100% disagree. I need zero training to buy stock, zero training to bet on the roulette table, zero training to buy crypto. I think the fact that somebody can go out there, see the asset, see a market, it's like buying what you know, right? If you live in a house and you see or you're renting in a building and you're like, wow, my building is a great building, and you see one going up next door, or you're seeing the neighborhood and something being built, and you're living and breathing and working there all the time, and you have an opportunity to invest in something going in your neighborhood. That's way more due diligence than just buying a stock that my stockbroker or money manager or Robinhood or whoever, whatever vehicle I use to invest tells me to invest in, or that I go out and say, oh, I like this retailer, so I'm going to invest in it.
But do you feel that there should be no guardrails for this type of investment? Because remember, in your daughter's case, it's very unique.
But I don't know how unique it is. I'm thinking of this other kid. He went to college. He had a degree in finance. He was getting his master's in I don't know what. And this was a family friend that he wanted to invest in this fund because he's seen his family friend making money. He's gone and seen what this guy does. He interned with him. And he's socked away 25 grand, right? And he wanted to put in the friends and family part of the fund, he wanted to put some money in, and he can't. So to me, maybe it's you must have, you can invest maybe more than a certain percentage of cash that you have, or a certain percentage of what you own, so that you're not going to wipe yourself out. Although, again, I can wipe myself out, and many people do on the roulette table. So anyway.
Yeah. And by the way, that was one of the suggestions that I read, was this idea of doing like some sort of tiered limits and all that stuff. But I mean, that also, is very limiting. There's got to be something to say about the relationship that, for example, in that case, that gentleman has with the people that want to invest. And in the case of your daughter, the same thing, the relationship she has with you, of course, and then with the people that she knows are investing in it, and the people that are running the show that are going to actually manage the asset and all that stuff.
So those minimum guardrails I'm good with, but training and having to take a class, that's just going to create a bunch of people making up stuff or putting stuff in AI and pretending they're an expert, and now I can raise all this money. Like, to me, that's even scarier, right? Because now I can create whole programs and pretend that I know what I mean. Not that they aren't already, but I think that's some of the issues that we saw during COVID. A bunch of people who didn't know what they were doing got in and didn't prepare for the worst and didn't think interest rates would jack up as fast as they did, and they did. And does that mean they're going to fail? No. Does that mean they're having some hard times? Most definitely. Does that mean there won't be challenges and they might come out still well on the other end? Absolutely not. But nobody predicted COVID, right? And the after effects. So there's always risk to everything. I mean, there's risk getting out of bed. Anyway, that's my rant for the day. So that's why I don't say fancy stuff like salutation.
Well, what I like that you left a rant for our episode, which is great. So we wonder if you, our listeners, have any thoughts on the matter. Should the accreditor investor guidelines be changed, be expanded? What are your thoughts on that? We would love to hear from you. As always, you could find us anywhere where you get your podcast, and we have our YouTube channel as well. So we would love to hear from you. Once again, thank you very much for listening.
And I am going to tie in salutations to our kindergarten series, because salutations is what Charlotte, the spider from Charlotte's Web, would say. How did you think? Sophisticated I am.
How do you think I learned that word?
Oh, there you go. Okay.
That's perfect. Well, thank you everybody for listening. Until the next time, bye.
Bye.